Picture this: a world where the old rules of corporate finance are turned completely upside down. Imagine a single publicly traded company not merely dabbling in cryptocurrency, but plunging headfirst into its depths, resurfacing as the undisputed largest corporate holder of Ethereum anywhere on the planet. This is not the tale of a conservative company testing the digital waters with a toe or two. Instead, it's the story of SharpLink Gaming, which has just rewritten the corporate treasury playbook in a way that could permanently alter the landscape of global finance. Is this audacious move the act of visionaries shaping the future, or a dangerously high-wire act that could have unforeseen, even catastrophic consequences? Join us as we dive deep into this game-changing event, examining the risks, the potential rewards, and the far-reaching ripple effects that could transform not just the world of finance and technology, but also your own perspective on money itself. To grasp the magnitude of SharpLink's actions, let's start with some background. For decades, the unspoken commandments of corporate treasury management centered on caution and reliability. The guardians of corporate war chests clung to government bonds, vast cash reserves, and ultra-liquid, minimal-risk assets. If you dared to suggest, just a handful of years ago, that a company should allocate a significant portion of its treasury to something as volatile as cryptocurrency, you'd have been laughed out of the room. Cryptocurrencies were viewed as wild, volatile, and untested. But times changed. By the middle of the 2020s, the ground had shifted. The world watched as pioneers like MicroStrategy made headlines by transforming Bitcoin from a speculative oddity to their primary reserve asset. That move was widely seen as reckless, until it wasn't. MicroStrategy's boldness cracked open the gates for institutional adoption of digital assets, setting the stage for a new era. Yet even that dramatic leap pales in comparison to what SharpLink has just accomplished. In June of the year 2025, SharpLink Gaming executed a direct purchase of more than 176,000 Ether, acquired straight from the Ethereum Foundation itself. Then, in a matter of weeks, they doubled down, acquiring an additional 10,000 Ether, again, directly from the Foundation, at a cost exceeding $25 million. These two bold moves have propelled SharpLink into the stratosphere. Their aggregate holding now exceeds 186,000 Ether, with a current valuation comfortably above $500 million. Take a moment to let that sink in. One company, holding more Ethereum than any other publicly traded entity on Earth. But this wasn't just a matter of placing a colossal buy order on a public exchange. This was a meticulously orchestrated, direct transaction with the very stewards of Ethereum's mission, the Ethereum Foundation. Such a deal isn't just about buying digital coins. It signals a level of institutional trust, strategic alignment, and mutual vision that few have ever witnessed in the crypto world. In a public statement, Joseph Lubin, SharpLink's chairman, Ethereum co-founder, and CEO of Consensus, laid it out plainly. This isn't a trade. It is a commitment to our long-term vision. We're removing ETH from circulation, staking it, and aligning our mission with Ethereum's push for decentralization and sustainable finance. Let's pause to consider the gravity of Lubin's involvement. Joseph Lubin is far from a bandwagon-jumping executive. His fingerprints are etched deep into the bedrock of the blockchain revolution. His simultaneous roles as Ethereum co-founder and leader of Consensus lend SharpLink's strategy not only credibility, but a sense of historic inevitability. But what exactly is SharpLink aiming to achieve with such a monumental move? And why did they choose this moment to act? SharpLink hasn't simply parked its Ether, hoping for passive appreciation. Instead, more than 95% of its ETH holdings are actively staked locked up to secure and maintain the Ethereum network itself. In exchange, SharpLink is earning between 4 and 6% annually in staking rewards, paid in Ether. To put this in perspective, since early June of 2025, SharpLink has generated over 322 Ether in staking yield alone, translating into millions of dollars in additional income without lifting a finger. This is not the old speculative gamble. This is a bold new hybrid model for corporate treasury management, one that blends potential appreciation with ongoing, programmatic yield generation. But why focus on Ethereum, and why right now? To answer this, we need to zoom out and look at the broader context. Ethereum is not just another cryptocurrency. It is the programmable backbone of decentralized finance, the foundational layer for smart contracts, decentralized applications, non-fungible tokens, and a rapidly expanding universe of financial innovation. With the advent of spot Ethereum and Bitcoin exchange-traded funds, traditional institutions now have safer, regulated avenues to gain exposure. Recent research reveals that institutions collectively hold nearly 4% of the entire Ethereum supply, valued at more than $12.5 billion. This is a tectonic shift in how mainstream finance perceives crypto assets. Even some of the most established financial names have entered the Ethereum ecosystem. Take World Liberty Financial, for example, a firm linked to the Trump family. They hold over $150 million worth of ETH and actively deploy it in DeFi protocols like Aave to generate yield. This is not just passive holding. It's dynamic participation in a living, breathing digital economy. These examples underscore a growing convergence between traditional finance and cutting-edge blockchain technology. SharpLink's approach, however, takes things even further. Unlike MicroStrategy, which famously adopted a Bitcoin-only, hold-at-all-costs strategy, SharpLink is an active, hands-on participant in the Ethereum ecosystem. The company not only holds Ether, but also stakes and restakes its assets, deploying them to maximize returns while simultaneously supporting the security, decentralization, and integrity of the network. As Siamak Masnavi of Yahoo Finance put it succinctly, SharpLink emphasized that its goal is not just to hold ETH, but to actively deploy it through native staking. The implications of this move ripple far beyond SharpLink's own balance sheet. On the upside, staking enables SharpLink to earn predictable, inflation-resistant returns, effectively transforming its treasury into a powerful, yield-generating engine. With Ethereum's proof-of-stake consensus mechanism now firmly in place, staking has never been more accessible nor more integral to the network's health. The recent Pectra upgrade, rolled out in May of 2025, has ushered in lower transaction fees and remarkable improvements in scalability. These technical leaps make Ethereum increasingly attractive to institutional players, potentially accelerating the next wave of capital, innovation, and adoption. Yet where there is opportunity, risk is never far behind. SharpLink's towering Ethereum holdings now represent a significant chunk of its overall market capitalization, exposing the company and its shareholders to the legendary price volatility of the crypto space. The aftermath of their most recent Ethereum purchase is a case in point. After the announcement, SharpLink's stock price soared by more than 28%, only to suffer a gut-wrenching nosedive, plunging over 70% in a single day after investors misunderstood a regulatory filing. This kind of volatility can erase billions in market value in the blink of an eye, leaving both executives and shareholders reeling. As one analyst at Seeking Alpha observed, SharpLink's shares are down nearly 70% despite acquiring ETH worth hundreds of millions, indicating deep investor concern. The market's message is clear. While the rewards may be enticing, the risks are equally, if not more, daunting. Let's break down these risks even further. Staking, while lucrative, comes with its own set of challenges. By locking away more than 95% of its Ethereum, SharpLink sacrifices liquidity and flexibility. If the price of Ether were to crash suddenly, or if a major vulnerability in a smart contract were exploited, the company could face catastrophic losses with little ability to respond. And then there's the ever-shifting regulatory landscape. The United States Securities and Exchange Commission has yet to permit issuers of spot Ethereum exchange-traded funds to stake investors' ETH deposits. Should regulators decide to clamp down on staking or impose new restrictions, SharpLink could find itself in a legal quagmire, with billions in assets potentially stranded. Another crucial issue is concentration risk. With such a substantial percentage of its market value tied up in a single, highly volatile asset, SharpLink increasingly resembles a high-octane crypto hedge fund rather than a traditional gaming company. This makes some analysts and many investors understandably nervous. Dalmas Ingetich, a respected voice at 99 Bitcoins, summarized the mood. Ethereum price targets $3,500 amid institutional demand, highlighting bullish sentiment. But the flip side is that these price targets can evaporate in an instant if sentiment turns. So, is SharpLink's strategy truly visionary? Or is it a reckless roll of the dice? To answer this, let's examine some historical analogies. In centuries past, gold was the ultimate store of value, a bulwark against inflation, political upheaval, and currency crises. Over time, companies began experimenting with holding foreign currencies and equities in their treasuries, sparking heated debates about risk and return. In the 2020s, MicroStrategy's Bitcoin Gambit was hailed as revolutionary, until the company's stock price became tethered to the wild swings of the Bitcoin market, earning both adulation and skepticism. Now, SharpLink's Ether-heavy strategy could set a new precedent. If Ethereum continues to appreciate and staking rewards deliver stable income, SharpLink might be remembered as a trailblazer for a new era of corporate finance. There is growing speculation among analysts that, if SharpLink's approach proves successful, we could witness a flood of Fortune 500 companies allocating significant portions of their treasuries to Ethereum staking, participating in decentralized finance protocols, and fundamentally redefining how risk and opportunity are managed in the digital age. But let's not ignore the possibility of things going south. The risks are as real as the rewards. A sharp correction in Ethereum's price could obliterate years of gains in mere hours. A sudden regulatory crackdown on staking could lock up billions in otherwise productive capital, and the threat of smart contract exploits or catastrophic bugs remains ever present. A single flaw in the Ethereum protocol could send shockwaves through the entire ecosystem, triggering a cascade of losses. The lesson here is as old as finance itself. The greater the potential return, the greater the risk. In the world of crypto, the rewards may be alluring, but the risks are unforgiving and immediate. Yet, it's not all peril and pessimism. SharpLink's direct purchase from the Ethereum Foundation and its decision to lock up such a vast trove of Ether in staking has profound implications for the broader market. By removing a substantial quantity of Ether from active circulation, SharpLink is heightening scarcity, making it increasingly difficult for other large players to acquire ETH at scale. This classic supply and demand dynamic could, over time, drive prices even higher, showering early participants with outsized rewards. There's another dimension to this story: institutional validation. The Ethereum Foundation's willingness to engage in a direct, high-stakes deal with a publicly traded company marks a watershed moment in the relationship between traditional finance and the world of blockchain. It signals a deepening mutual trust and sets the stage for further cooperation, potentially accelerating the adoption of decentralized technologies across the institutional landscape. Looking forward, what does the future hold for SharpLink and for the global financial ecosystem? Several scenarios could emerge. In the most optimistic case, Ethereum's ongoing growth, combined with the maturation of Layer 2 scaling solutions like Optimism and Arbitrum, could make decentralized finance accessible to billions of people worldwide. Corporate staking might become a mainstream treasury strategy, with companies earning steady, inflation-resistant yields while helping secure the very infrastructure of future finance. If the Securities and Exchange Commission eventually permits staking within spot Ethereum exchange-traded funds, a tidal wave of new institutional capital could flood the ecosystem, further validating SharpLink's approach and potentially driving its stock price to new heights. Alternatively, the road ahead could be fraught with challenges. A prolonged bear market in crypto, adverse regulatory developments, or a major technical setback within the Ethereum network could derail SharpLink's plans and inflict significant financial pain. In such a scenario, SharpLink's stock could become a volatile barometer of crypto market sentiment, a roller coaster that rewards the bold but ruthlessly punishes the unprepared. The company could transform from a pioneering hero to a cautionary tale, serving as a warning to others contemplating a similar leap. What does all this mean for you, the viewer? Whether you are a seasoned investor, a technology enthusiast, or simply crypto-curious, the takeaway is crystal clear. We are living through a pivotal moment in the evolution of finance and technology. The old rules, relying on safe cash, slow and steady government bonds, and incremental change, are being challenged by a new breed of entrepreneurs and visionaries willing to take calculated risks for the chance at extraordinary rewards. Understanding the mechanics of digital assets, staking, and decentralized finance is rapidly becoming essential knowledge for anyone interested in the future of money, investment, or technological innovation. Let's distill some actionable lessons from SharpLink's bold experiment. If you are an investor, recognize that the risk-return profile of crypto-heavy corporate strategies is fundamentally different from traditional approaches. Diversification, rigorous due diligence, and robust risk management are more important than ever when dealing with assets this volatile. For companies considering a similar path, SharpLink's journey, its triumphs, and its stumbles, offers a treasure trove of insights. Learning from both the successes and the pitfalls of being a first mover is crucial. For regulators and policymakers, SharpLink's experience provides a living, breathing case study in the challenges and opportunities inherent in integrating blockchain technology with legacy financial systems. Before we wrap up, let's not overlook an important but often underappreciated dynamic. By buying directly from the Ethereum Foundation and committing its Ether to staking, SharpLink is effectively engineering a supply shock. With circulating supply shrinking, scarcity increases, which, according to classic economic theory, should eventually drive prices higher. This is straight out of the economics playbook, updated for the digital age. If more companies follow this model, Ethereum's liquidity profile could be fundamentally altered, with far-reaching consequences for price discovery, volatility, and the long-term health of the ecosystem. Let's also consider the impact on the broader tech and innovation landscape. SharpLink's move is not occurring in isolation. Across the globe, companies are taking a hard look at how decentralized technologies can offer not just new financial tools, but also new ways of doing business. From international payments to supply chain management, the principles underpinning Ethereum, transparency, programmability, and decentralization are being explored in a wide variety of sectors. SharpLink's willingness to go all in could embolden others to experiment, potentially accelerating the pace of technological disruption. There's a social and ethical dimension as well. By staking such a large portion of Ethereum, SharpLink is actively participating in the security and decentralization of a public good. It's a bet not just on profit, but on the idea that a decentralized, open financial system can be more inclusive, transparent, and resilient than the centralized models of the past. This raises intriguing questions about the evolving role of corporations in society. Are they simply profit-seeking entities? Or can they be architects of new, more equitable economic systems? So as we circle back to our central question, will SharpLink's Ethereum strategy be remembered as a visionary masterstroke or as reckless folly? The answer will depend on a swirling interplay of regulatory developments, technological resilience, market sentiment, and the actions of other institutions. Right now, with Ethereum's price on the rise and staking rewards providing a steady income stream, SharpLink stands as both a pioneer and a lightning rod. The company's risks are undeniably huge, but so is its potential upside. The story is still unfolding, with every day and every new block written into the blockchain. Ultimately, the saga of SharpLink and Ethereum is a microcosm of the larger transformation sweeping through global finance. As the boundaries between traditional finance and crypto blur, and as the next generation of treasury managers weigh risk and reward in a world of relentless change, decisions like these will shape the future. Whether you see this as bold innovation or dangerous speculation, one thing is certain. Ignoring this transformation could mean missing out on the next major chapter in the story of global finance. If you found this deep dive thought-provoking, don't forget to subscribe. Share your thoughts below. Do you think SharpLink's move is visionary or reckless? And hit the bell icon for more stories at the intersection of global economics and technology. Until next time, stay curious, stay informed.